And the outcome there was yield curve control, which is, it's all the same thing. And so you run inflation slightly hot, and then you just have financial repression for 20 years, and it gets rid of most of the sins.
Is the gold price. Okay, gold has gone up 25% in the last year. Great. Okay, that's good. It does what it says on the tin. But Bitcoin went up 150, wasn't it?
Even if he moves out further duration, the market won't take it without liquidity. Whether it's some form of QE. I think you're rightly suggesting nobody wants to use the word QE anymore because it's a dirty word. So they just find any other way of hiding it.
Hey guys, welcome to Everyday Finance. Whether you're ready or not, the business cycle is happening. Risky assets will respond, your portfolio will be affected, and even your personal funds will be affected. That part can't be skipped. How you react is something you can change. Raoul Pal says that most investor frustration is not caused by how the market is doing, but by unrealistic assumptions about when things will happen. People want quick profits, clear information, and steady gains, but the markets don't work the way people want them to. They go through cycles that are caused by money flow, loans, and liquidity. People get antsy when markets stay flat or go down. Investors get sidetracked, jump from story to story, and forget about the bigger picture. But as Pal says, the global setup is already moving forward. There is more money flowing again, ISM signs are beginning to rise, and the cycle is starting to play out as planned. Still, a lot of people freak out when Bitcoin stops working or sell altcoins when they don't do well. They think that being stuck is dangerous and miss the real chance. A lot of altcoins move with the risk curve. When ISM goes up, capital moves farther out. Altcoins rise, Bitcoin loses its power, and the market cycle speeds up. It's not guessing. It's how the system works. People who understand this and keep their place will win a lot. Stay until the end of the video to see Raoul Pal draw out the big picture and explain why the best times are yet to come.
To me, it feels like 2025 is potentially a perfect storm for liquidity, right? All of the chickens come home to roost. Something has to happen here. And we're in that pause zone. Yes, the TJ may help for the time being. And then really that Trump administration wants it. Maybe it will clear the debt ceiling forever, i.e. get rid of it. And that frees things up and that changes the structure a bit. But I can't help but think within that construct you and I have talked about where everybody has to provide liquidity to monetize this debt, you've also got the Trump administration, which is all about growth in markets. Mm-hmm. And it will not pass their attention that the easiest way to fake the growth in markets is just to continue adding liquidity.
Yeah, I go along with that. That may be a solution. I mean, it's a feel-good factor for sure. But then you're in an environment where you've got monetary inflation, you've got underlying high street inflation in the US already, I think, over 3%, near 3.5%. And that's pretty much what the Michigan survey is already indicating, the expectations of about a week or so ago. That's more or less saying that. So underlying inflation is higher. That may well limit the Fed's room in interest rates, which means there's a lot more emphasis which has got to go back on the balance sheet, which strikes me that the inevitable course has got to be back to QE at some stage and rather sooner than later. So I think all these boxes are ticked. I think that's absolutely right. But all I'm saying is that I think that's a great way out. I think that the Fed has got to lead on this, and I think China will follow through, very, very quickly because it has to. The question is who fires the starter's gun and when. And it might be that this is 3 months away. It may be that it's sooner. I can't really see it happening sooner, but it could be, we're talking about maybe summertime for this. But what that would mean is maybe there's an opportunity to buy these markets cheaper before they go up again. But, all I'm suggesting is there's dangers near term from an air pocket because the dollar is strong. That's a wrecking ball. The bond markets look fragile. That's a problem. And we haven't really got clarity yet on what the Fed wants to do with its QE policy.
No, although I think we'll be rescued by the TGA. One thing I've used is, and I think you and I have talked about this before, I've used the framework of the 1950s, post-World War II. as
Right.
this, and we had that same everything code cycle of every 4 years of rolling the debts, and the outcome there was yield curve control, which is it's all the same thing. And so you run inflation slightly hot, and then you just have financial repression for 20 years, and it gets rid of most of the sins. Do you think yield curve control is an easier way to do it?
Well, my view is that I think to come back to the financial repression point, I sort of get the financial repression. I kind of agree with that. I think the issue is that there's a lot in there in terms of assumption about what the government can really control, and or does the Fed and the Treasury really have the ability to control all these things? Can they really control inflation? Can they really control the bond market, etc.? And I think that, in 1945, it was a lot easier than it is in 2025 in many cases, because things are a lot more international. There are fewer, there are no capital controls or limited capital controls. So I think it's kind of more difficult. And what I would say is that I think the solution to this is not necessarily, financial reversion will play a role in it, but I think the big issue is this thing about monetary inflation. And the differences between monetary inflation and high street inflation. The two are not necessarily the same thing.
No.
And inflation always used to be, in economist parlance in the 19th century, devaluing paper money. And that's what we're really talking about. They're devaluing paper money. It's not actually that gold is going up. It's actually that everything else is going down.
It's
right. Devaluing against gold. Gold is the pole star in the sky, which holds its value, right? And that's what we got to think about. And, I sort of take this point that if you've got a backdrop where global liquidity is compounding at a rate of 8 to 10% per annum, or whatever the figure is, you've got to choose assets in your portfolio that at least have got to deliver that sort of return. And if you're getting a bond of 5%, it ain't doing that, right? You've got to think about things like gold. Gold, if you look at the longer term, and I'm sure you've done the same analyses, but look back to the 1970s, one of the very few assets that's actually kept pace with global liquidity over that period is the gold price. Gold has gone up 25% in the last year. Great. Okay, that's good. It does what it says on the tin. But Bitcoin went up 150, wasn't it?
The first part of the banana zone began in the crypto market in late 2023. Right after Raoul Pal's global M2 model was set off in September, Bitcoin has followed that model almost exactly every time since then. Still, a lot of people keep asking, when banana don't see the flashing green macro signs? The growth of global M2 is now at its fastest rate since the reflation boom after COVID, since October 2023. Central banks have added over $2.3 trillion in net liquidity, mostly in Japan, China, and parts of Europe. Even though the Federal Reserve is still on hold, things are getting better for the economy in the U.S. 2-year yields have dropped more than 75 basis points from their all-time highs. And at the same time, the dollar keeps getting weaker. Powell thinks the DXY will fall to 92 or even lower. There is a lot of demand for risky assets like Bitcoin, Ethereum, tech stocks, and altcoins. This is because global liquidity is rising. Yields are falling, and the dollar is weakening. Signs are already set up. Most people aren't looking.
Lots to pick apart from there. So the first thing I'm thinking is, obviously we've, breaking down liquidity, the reverse repo is almost drained now, and that'll be drained soonish, which probably suggests an end of QT, because you can see bond market liquidity is not great. And you can see that around the world. There's just not enough liquidity in the system. The gilts market's been a mess, stuff like that. So it feels that they're going to have to end QT as soon as the reverse repo drops. Yellen's made it pretty clear that, even though it's Scott's job now, she's going to have to draw down the TJ until they agree something on the debt ceiling. So that, I guess, is a net liquidity injection that's coming from that. How do you measure this shorter-term funding dynamic? In what does that show up as stimulus? Because that's not something that most people are capturing. I read your stuff, and I know you've been talking about it a lot, and it makes sense, but does it get captured elsewhere? Or do you have to just look at bill issuance in its own right and add that to liquidity measures?
You mean you're talking about the funding, how she's changed funding?
That's right, the very short-term debt.
Well, what I've done, there's actually a slide in a pack I sent you, which is actually slide 25, which you can slide into the tool. But basically what that shows is my estimates of what I call not QEQE, which is what Jay Powell does, and which is the TGA and things like the rundown of the reverse repos. And you've also got on top of that the other bit that I've called not yield curve control, which is unconventional funding. And that is something like about together, they're adding something like about 6 trillion to stimulus. Now, the way that I've done that is to look at a concept called dollar duration and to look at how dollar duration has changed and put that in liquidity equivalent terms. So that's how I estimate it. And that's really against a normal funding benchmark. The skew has been quite noticeable because as you understand, I mean, treasury bill finance has gone up hugely. Bills have been a large proportion of what's funded the deficit in the last 12 months. And on top of that, Janet's skewed the issuance calendar away from long-dated coupons towards shorter-dated ones. And she's taken about a year and a quarter on average out of the average, treasury auction.
Does that change the debt refi cycle? Or does this just get mopped up in this kind of final year of the debt refi cycle, the 4-year cycle? Or have they restructured it where we're going to end up with, as opposed to a 4-year average cycle, we end up with a 2.5-year cycle?
Well, that could be the case, couldn't it? It could be short cycles are shortened, and they're going to have to, they're going to have to start pushing a lot more liquidity back more immediately. I mean, that may be the issue. I mean, we know that Scott Bessen's got to fund 30% of the deficit 30% of the outstanding debt this year.
Yeah. And so even if he moves out further duration, the market won't take it without liquidity, whether it's, some form of QE. I think you're rightly suggesting nobody wants to use the word QE anymore because it's a dirty word. So they just find any other way of hiding it.
Yeah, exactly. And I think this is the reality, because if they don't add liquidity, who's going to buy this debt, this coupon debt? And we know the structure of the treasury market is itself quite fragile because, foreigners are not really buying American debt anymore in the size they were. A lot of it's coming down to hedge funds. Those hedge funds, as you will remember, they're fairly fickle or certainly short term. They want to earn a profit. And as the yield curve is steepening, the cost of hedging is going up the whole time. So often, as you will recall, you see breaks in markets where suddenly people just bail out. And that's the problem the treasury market could face, a spike up in yields. I mean, we're doing pretty well at the moment, aren't we? I mean, yields have moved up quite smartly anyway. And it's term premium. This is the thing.
Yeah, it feels like, there's a lot of moving parts for Scott Besson to now navigate. I guess drawing down the TJ helps in the interim, but then they have to figure out something more structural for them to do this. But that sort of times with Basel IV coming in as well. Do you think this new administration will follow the Basel IV thing? Because I think it's in place in Europe now, or at least starting. And then the UK.
Yeah, there's talk about delaying it, but I mean, generally they're moving faster than the US.
And that to me just seems another way of just forcing banks to hold more of the bonds.
Yeah, I mean, that's all it is. Yeah, exactly that. I mean, this is financial repression sort of in practice. I mean, this is what's going on. They need more and more people to hold the debt. But I think the fact is they're running out of safe hands. So ultimately, the central banks are going to have to do it themselves. Particularly if they're moving away from bill finance. I mean, the one luxury that bill finance offered was that the banks tend to buy that stuff with alacrity. But if they're not issuing bills, they're going to have to get people to buy coupons. And that demand is not really there. You may have read, but there's been a lot of disquiet among pensioners against their pension fund managers to say, why on earth are you putting 20, 30, 40% of my fund in bonds? And bonds, remember, have lost 25% on average of their value since 2020. So, there's pushback there. So the pension funds don't really want to hold too many bonds. So the only safe pair of hands you can think of are the central banks.
Yeah, or the banking system, as long as they don't have mark to market. Yeah, exactly. And you can stick it on Jamie Dimon's balance sheet for quite a period of time.
Yeah. Yeah. So there are routes out. I accept. But it's getting to the stage where you need that central bank impetus.
And how do you think that plays out in the US? Have you said Canada's started doing something? But do you think, what is your hunch that the US just continues in the debt monetization path, and that even though we can't see it clearly yet, there's relatively obvious paths?
MicroStrategy, the biggest company that holds Bitcoin, just met the last requirement for possible inclusion in the S&P 500. This means that Bitcoin may be getting even closer to being fully integrated with mainstream finance. The company was held back for months by out-of-date accounting rules that made it report unrealized Bitcoin losses as real damages. But because the Financial Accounting Standards Board recently changed the rules to allow fair value accounting for digital assets, MicroStrategy is now expected to make a huge $14 billion profit in Q2. This is on top of the $11 billion gain it had in the previous year, which is more than enough to meet the requirements. Even though getting into the S500 isn't a given and still rests on the index committee's decision, the door is now open. What's the catch? Analysts expect a heated discussion because MicroStrategy appears to be more of a Bitcoin holding vehicle than a normal running business. This makes them wonder where it fits in the index. Still, if accepted, this would be the second crypto-related company this year, after Coinbase. To join the S&P 500, even more important, all funds that follow the S&P 500 would have to buy MicroStrategy shares to get exposure to Bitcoin indirectly. Holds more than 597,000 Bitcoin, which is about 3% of the total amount. This could be a big step forward for Bitcoin adoption. Is this a big step forward for the legitimacy of crypto? Or is it a bad example? Type your ideas in the box below.